Hey, I wanted to basically say that recessions here, and recession creates opportunities. Today is about the Wake County real estate, and today is the February 2023 housing report. And looking at the information that's been given out here, this is the housing demand that we've seen, of household formations. And what I mean by household formation, this may be children leaving the household. This may be, divorce situations where one person leaves the household, the other one stays in the existing households. But this is new households being formed as population forms. And so this is what we're seeing here. And so if we're looking here currently, we're averaging about 1.4 million households formations since the beginning of 2000. So over the last 23 years, this is what we're averaging. And so if you look here and see what we're averaging, or currently where we're at versus what we're averaging, you're going to see that the households are outpacing what demand is for homes. And so thinking that we're going to have a repeat of 2008 all over again, I just don't see that. As you can see, since the end of 2016, where we were sitting at right here where my cursor is, we were sitting about right here between 1.4 and 1.5 million homes. We've seen it steadily fall to where today we're sitting at 578,000 homes. And, so that's what's existing inventory is on the market. And as you've seen here in the pandemic that we went through, housing got underneath that 600,000 mark. And as we start to get under that mark, we remember the competing offers when you were out there trying to make an offer on a house, and there was 3 offers that came in, and you as a realtor were just opening up the door, and the client was saying, "Hey, I want this house," or they were just riding by and say, "I want this house." Well, as we're looking at this number, we're heading back towards that direction as the interest rates and things start to cool off. So if we look based upon the housing inventory, this is 2000, and where my cursor is, this is 2008. We had 4 million homes. We had homes falling, in price and median price, and we were struggling with that as the excess inventory was on the market. And let's face it, builders have learned a lot from that. And so now it's more of a just-in-time inventory because we're seeing they want to keep their prices up and they don't want to saturate the market. So 2012, we've gotten rid of it. We've gotten rid of 1.6 million homes, and now we're down to 2.4 million homes. Well, as we started to enter 2012, when we started to, and rates dropped and we started to get rid of excess inventory in the market, what happened? People who bought in March of 2012, by the time they got to the end of 2013, saw an 8% rise in their home values, just because we were coming out of the recession and they were lowering the rates, and it was Katie Bar, hold the door, let's get inventory on the ground, let's get going. Today, it's a completely different situation than it was in 2008, as we're sitting here with about 980,000 homes of existing homes and inventory on the market, well below that 4 million we had back in 2008, of which 402 are under contract. So we have active listings across this country of 578,000. And if you take that number and you really paid attention to it, that's about 1.5 months supply of inventory we have in this market across the U.S. So the opportunity here that is really here is it's really difficult to get to the exact bottom. You as a buyer, you as a seller, nobody knows where that bottom truly lies, but we try to get there because that's where the opportunities are. If I'm guessing right based on the data that I'm seeing, we are somewhere in the middle. We are either at the bottom or close to the bottom, in my opinion. And so as you start to head towards the bottom, the seller's more fearful. They're willing to negotiate. Builders don't put as much inventory on the ground because they don't have as many buyers to buy homes. So they're trying to unload their existing inventory. They're giving deals. They're giving 4.99 rates. They're giving, closing costs that they haven't had to give in a while. And as they get rid of that excess inventory, their bottom is leveling out. And as that bottom levels out, what happens is there's not as much to choose from. The seller starts to become a little bit more confident. There's more competition, and they're less likely to give concessions. That's why it makes sense to buy a home in today's market. we look at the numbers and we really dive into the numbers of January, we had year over year, we kept seeing price increases. And I think this is very interesting as we look from last year's number to this year's numbers of where we are in values, in home values. A couple of things that stand out to me is the number of months supply of inventory. We were at 1.4 in January. We were at 1.2 in February. We're headed back below 1 month supply of inventory in our market if things continue to hold steady and that trend holds in the direction it's going, which is kind of scary. I mean, because once we got below 1 month supply of inventory, that's where the bids started to happen because there was not a lot of inventory out there. And so people were willing to pay. So let's talk about the average sales price and the median sales price. Well, the higher end homes are not as many are on the market or a plethora on the market. And it's kind of like those have a bigger payment adjustments. A 0.25% rate or 1% rate on $1 million is going to adjust that payment quite a bit, close to $500 to $1,000, somewhere in that range. So we're not seeing as many of the higher end home sales. So if we're not seeing as many of the higher end home sales, your median price is going to be dropping. It's not that the values in our market are going down. It's just that the higher end homes aren't selling. There's just not as many on the market, and they're not as desired today because of the excess cost and the payment. That being said, if you're out there in the market and you're paying attention and you're going after the lower end homes, you're still competing. It's because there's just not a lot of market. If you were to go in there and Google the inventory, you would see that, and you would not Google, but go to realtor.com and you go put in Wake County sales price between, let's do Wake Forest. Wake Forest sales price between 350 and 400,000 has all two existing homes sitting on the existing market in the 27587 zip code. If you were to look in the Cary zip code 27511 and you were to look in that market and you were to look between 375 and 450, you're going to be lucky if you find one, maybe two. The market is definitely a tough market on the lower end. It's still competitive. The higher end market is not as competitive, but if you look here and see another thing that probably I could point out to you, tell you that lets me know where at the bottom is the percent of list price received. Which that means is that if they're listing their house and it's listed out there, it's moving up. In January of 2023, we were at 97.7%, which means that 2.3% of the house price of what it was originally listed at, the seller was negotiating. Now that's moved. That's actually moved up 9/10 because when I look at February, it's at 98.6. And that tells me that the market is gaining strength. There's that, and the fact is that the month supply of inventory is getting less. Two concerning trends there that I think that tells us that if we go back and we look at that trough again that we just talked about, we're at the bottom. Being at the bottom or close to the bottom is when you should be out looking to buy the house. You can marry the house, but you date the rate. And what I mean by that is if we were to look at this is a chart of the MLS, and it goes all the way back from 2006 through 2009, as you can see where we had that steep decline, and then boom, it went back up. Well, housing caused that recession, and housing is always going to be struggling when it comes to that. And so the recession bumped along, and then boom, when the recession finally started. We started to get out of the excess inventory in 2012. You can see where home prices really started to shoot up. And then we could see where there was some flatness in the market and home prices dipped back down a little bit, and they shot back up again. And keep in mind, interest rates follow inflation. Well, if you're paying attention and you heard what the Fed had to say yesterday, you're going to know just as well as you're going to see just as well as what I saw. The Fed said that the market it's improved. Inflation's improving in everything, and your rents are lagging, and rents make up 44% of CPI. And so with the rents a year ago in 2022, what was happening? We were at the peak of the housing market right here, And if you owned a rental property or you know a friend that was renting, their rents were going up 15 to 20%. So if you were paying $1,000 on it, your payment went from being $1,000 to $1,200 or $1,150. Your rents were going up. Well, those rents are on the books for a year. Those rents being on the book for a year did what? It's caused the rentals, the rentals to go up. And if CPI is made up of rentals, we're lagging. So as we start to get to the rents that are being replaced this year, you're probably seeing some rentals in the market. You're probably seeing them go up maybe 3% at the most. You might see some rentals sitting vacant for a while as that, people have tightened their bootstraps and are prepared for the recession. So you're not gaining as much in rents as you were a year ago. And as we start to replace those numbers, we're really going to see this inflation fall. And if rates follow inflation, we're close to the bottom. So if we want to go back and really understand what a good investment is and why I should go out and buy something today, is you want to buy at the bottom of the market. And I feel like we're at the bottom of the market. If we go back and look at the history, even if I would have bought something in 2012, I still would have gained value in homes. But let's go back and just look where we're at from 2014. If you bought something in 2014 and you were to sell it today based on the average sales price, you've got a return of about 99.38% in just over 9 years, or about 11% in value increase year after year. And if you look at the average sales price, which just confirms what we saw in the median sales price, it's 100.10%, which is about 11.22% increase in value. Today's an opportunity to buy. I truly believe this market is going to continue to go up. If you got questions or you just need help putting strategies together, or you want to talk about how to buy a house in today's market with little to no money out of your pocket, or being able to afford a home today, or how to get through and what to prepare for in home ownership and buying something, give me a call. I'm here to help you. I'm here to guide you. You can't go wrong in owning real estate. I truly believe it's one of the biggest assets you'll have in your portfolio. As if you look at the top 5% of the wealth people in this country, their money is in real estate. And if you're going to have the opportunity of building wealth, today is the day you take that chance. You don't let the fear overcome you from heading towards the wealth that you're going to build down in the future.